Welcome to Class 102. This is an Introduction to Technical Analysis. In this video module, we will introduce the concept of technical analysis. After introducing the concept, we will then talk about basic technical indicators which are used every day in our stock analysis. This includes moving averages, support and resistance levels, trend lines, price, and volume. So what is technical analysis? Technical analysis is a method of evaluating securities, in other words stocks, by analyzing statistics generated by market activity such as past prices and volume. Technical analysis is mathematical based as we use past prices and volume to determine where the stock is likely headed in the future. This is quite different than fundamental analysis, in which an analyst tries to determine the theoretical value of a company based upon companies' balance sheets, earnings per share, book-to-debt ratio, and other financial numbers. Technical analysis is based upon what's actually happening to the price. Technical analysis works so well because it's driven by the powerful human emotions of fear and greed. This is what causes trends to repeat over and over. When I was a new trader learning about technical analysis, I thought, wow, this must be magic. How can a chart really determine where a stock is going to go in the future? I mean, after all, we're looking at the past. How can that predict the future? But what I failed to realize at the time is that technical analysis is not magical at all. In fact, all it is simply a way of plotting on a chart the levels of fear and greed in the stock market at any given moment. Greed is what makes stocks go up. Fear is what makes stocks go down. And whenever those levels of fear and greed start to increase, if the greed is increasing or the fear is increasing, then we see trends develop. Increasing greed causes uptrends. Increasing fear causes downtrends. When fear and greed are in parity with each other, we have stocks that move sideways. So if you look at it on a human level, technical analysis makes a lot of sense. All we're doing is plotting human emotions, and humans drive the market. You know, the market is basically driven by humans, and human emotions are what make stocks go up and down. Because human emotions don't change over time for thousands and thousands of years, those emotions of fear and greed have been the same. That's what causes these trends to repeat over and over and over again. That's why the cycles work over and over again, the uptrends, the downtrends, the support, the resistance, and so forth. And the great thing about technical analysis is that it works on any market and in any country. So the concepts you're learning in this course apply to any stock market you want to trade in the world, even commodities markets, futures markets, currency markets, because again, the emotions of fear and greed are what drives every market in every country in the world. And people are basically the same in that respect. Everybody has fear and greed and acts on those impulses of fear and greed, which drives stock prices up or down. The best thing about technical analysis is that it is based on what's actually happening to the price, not theory. The problem with fundamental analysis is that analysts try to create a theoretical value of the company. Well, the stock should be trading at this price because our analysis tells us that the company is worth this much. But the problem is it's theory. If the stock is not trading at that price, there's no guarantee it's going to get to that price, and I don't want to invest my money on theory. I'd rather base my money and make my decisions on what's actually happening to the price. That's all that matters in our analysis. All that matters is the actual price action. From the price action, we can determine where the stock is headed. We don't even care about news because the news is already going to be built into the price of the stock. And the nice thing about technical analysis is that it's easy to define and limit risk parameters through forming a firm strategy, which we will teach you. So by having a technical analysis background, you can actually set a strategy to limit, almost like a robot, the exact amount of risk that you want to take on every single trade based on trend lines, support, and resistance. That keeps your risk consistent and enables you to become more profitable over time through developing and improving on a firm strategy to manage risk. The first step in understanding technical analysis is understanding chart reading. Let's begin our technical analysis lesson by looking into two types of charts that we commonly use for analyzing stocks using technical analysis. First of all, we have a bar chart. On the bar chart, you will see on the left side here, the bar chart indicates four key factors. we have the opening price, we have the closing price, we have the intraday low, and the intraday high. The difference between the low and the high is the intraday range. What we're looking for generally is for the close to be higher than the open, but more importantly, for the close to be near the intraday high. That indicates the stock not only moved up for the day, but also showed strength throughout the whole day by holding near its intraday high. Now, a stock that's closed lower for the day on a bar chart will have the opening price here, and the closing price will be lower, and then the intraday high and the low would look the same. Now, what we use more of the time than a bar chart is a candlestick chart, and a candlestick chart looks a little bit different. With a candlestick chart, you have what's called the upper shadow, also known as the tail, and then you have the lower shadow, which is also known as a tail, and then the body of the candlestick. Now, if the stock closed up for the day, it will open near the bottom of the body and will close at the top of the body. So this shows the open price here and the close price here, intraday high and intraday low. And then if the stock moved down for the day or for the period, the open will be here and the close will be here, the bottom of the body, and the intraday high and the low of the shadows remain the same. Now, the color of the candlestick you use is customizable depending on what your personal preference is. But what you commonly will see is that green candlesticks bodies are indicating price movement that was higher for the day, and red candlestick bodies are candlesticks that move lower for the day. Now, interestingly, in China, red is considered to be a color of good luck. So in China, normally on candlestick charts, the red body will be a candlestick that's up, and the green body will be a candlestick that is down. With what you see, what we're teaching, green will be up and red will be down. Let's look at some of the basics of reading charts. What you're looking at here is a daily chart. A daily chart means that each candlestick bar you see represents one day of price action. This is called price action, the period you see here with all the candlestick bars. So what we're looking at here, if we look at the bottom, the x-axis, we're looking at a chart that goes back to May of this year. So we're looking at price action over the period of about 2.5 months here, from May to mid-July. What we also plot, in addition to candlesticks, is we plot volume. And each volume bar you see here represents one day of price action. And then we have a blue line which plots our 50-day volume moving average. We'll get into moving averages in a bit here, but this basically indicates what the average volume is of the stock. So if on any given day the volume comes in higher than this blue line, the stock traded more shares that day, more volume, than an average day. If the volume comes in below that line, the volume was lighter than average. At all times, stocks are basically in three types of trends. Stocks can be in an uptrend. Now, an uptrend is defined as a series of higher highs and higher lows. Stocks don't go straight up forever. They don't go straight to the moon. And what they tend to do instead is they move in cycles. They move up a little bit, pull back a little bit, move up a little bit more, pull back a little bit, move up even more, pull back a little bit. They don't go straight up. Maybe they'll go up for 3 or 4 days, pull back for 1 or 2 days, go up for 3 or 4 days, pull back for 1 or 2. That's if the stock is strong. That gets represented on stock charts like this. You'll see each of these H, or you see it labeled HH, that indicates higher high. Here we have a higher high, a higher high, a higher high, a higher high. So we've got 4 higher highs, and then higher lows. We've got 1, 2, 3, 4 higher lows. So stock goes up, pulls back, goes up, pulls back, goes up, pulls back, goes up, pulls back. Each time we're setting a higher high and we're setting a higher low, and this is the definition of an uptrend. Now, an uptrend, normally, or for our purposes, we'd like to see at least 2 higher highs and 2 higher lows formed before saying that the stock is in an uptrend. If we say it's in an uptrend with only 1 higher high and 1 higher low, we'll have a tendency to have a lot of false breakouts where the stock tries to move higher, but it doesn't hold up. It's unable to do so because we don't have enough confirmation. So with uptrends, we generally like to see 2 higher highs and 2 higher lows. Downtrends are basically the same but in reverse. With a downtrend, we've got stocks that are forming lower highs, LH, and lower lows, LL. So So here we've got lower low, we bounce, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So we're looking at a period here of about 5 months. And we can see the stock was clearly in a downtrend for the past 5 months. Downtrends are just like uptrends, meaning that stocks don't go straight down just like they don't go straight up. They tend to move in cycles, in waves, and that's what you see here with the formation of the lower highs and lower lows. The third type of pattern you will see is consolidation. So at all times, stocks are either in a consolidation period, like you see here, or an uptrend or a downtrend. Understanding what consolidation is very important because the stock market is in a consolidation period about 2/3 of the time, and at any given moment, the stock market's only trending higher about 1/3 of the time. So again, about 2/3 of the time stocks are going to be consolidating in a sideways range. 1/3 of the time they're going to be trending. So it's important to be able to identify when stocks are in a consolidation period. Consolidation is a period of trendless activity where the price action settles into a sideways trading range. The horizontal lines that we drew here for you mark the upper channel resistance and lower channel support, which we'll talk about shortly, that the stock was settled into. So basically, as you can see here, for a period of many months, 5 months, the stock was unable to move upwards. It didn't trend higher, but it also didn't trend lower. It simply went sideways, and that's what we call sideways consolidation. Now, consolidation can be healthy. It can be positive. It can be bullish for the market if this type of consolidation occurs near the upper end of a range. Let's say, for example, a stock has been trending higher, and then it enters into a period of sideways consolidation near the highs. If that consolidation occurs near the highs, it is bullish, and majority of the time, the stock will move higher after breaking out above the high of that consolidation. Now, conversely, a stock that's consolidating near the lows after a protracted downtrend will usually lead to even lower prices. So consolidation tends to lead to a resumption of the prior trend. If it's an uptrend, consolidation will normally lead to higher prices. In a downtrend, consolidation will normally lead to lower prices. The two most important indicators we use in all of our chart reading, price and volume. Price is the most important indicator, followed closely by volume. Price is important because really it's all that matters. We don't care about if the stock has good news or bad news or what the speculation is or what the analysts are saying. All that really matters is price. And normally that any news or any kind of fundamental expectations are already built into the price. So price is really all that matters for us. Now, second to that is volume. Volume is so important because volume is what creates price action in the market. More than 50% of the market's average daily volume is the result of trading by institutions. That means mutual funds and hedge funds and so forth. More than 50% of the shares traded hands every day comes from institutions. As a result, whatever institutions are doing, whether they're buying or selling, they have a tendency to move the market. So by paying attention to where the money is flowing from institutions, we can determine where the stocks are likely to move. So if we see volume patterns favorable, along with favorable price action, this matters more to us than any technical indicator out there. This chart you're looking at here indicates the ideal price with volume action we like to see. Now, when a stock is trending higher, what we'll normally see is higher volume on the way up, and then as the stock consolidates or slightly declines, okay, as you can see here, a slight decline, we want to see volume decline as well. And then when the stock rallies and goes above its prior high, okay, and forms a higher high, we want to see the volume increase, as you can see here. Then as the stock consolidates or moves sideways to lower, we want to see volume dry up again. And then as soon as the stock moves higher, forms another higher high, we want to see volume step in on the breakout. This is the ideal price action combined with volume patterns that we want to see whenever we're looking at a stock that's in an uptrend. Again, just to reaffirm, we want to see increasing volume on the way up and lighter volume on the way down. Now what that indicates is that when the stock's volume is increasing on the way up, it indicates that institutions are stepping in to provide support to buy the stock. But what we don't want to see is we don't want to see continued high volume as the stock consolidates, because that would indicate that institutions are selling into strength of the previous move, of the previous rally. Instead, when we see lighter volume during the consolidation, what it indicates is that the bears are not stepping in and the bulls are simply taking a rest. That's what it indicates when the volume is lighter during the consolidation. So keep this in your mind. This is very important. We want to see higher volume on the up moves and lighter volume, declining volume on the sideways to downward moves. And this is the healthy price action that enables uptrends to continue. Conversely, if we start seeing high volume during the consolidation and lighter volume during the rallies, that normally precedes a market top. Okay, so that's important to keep in mind that the opposite pattern that you see here can actually help us to determine when the market is nearing a top. Next, let's talk about support and resistance. Support is found on a chart. It's the level at which a stock refuses to go lower. In this particular example, notice that this horizontal line represents support right around the $65 level. Each time the stock comes down to this level, it bounces off it, moves higher, and it comes back down and bounces off it again. Resistance is the opposite of support. Each time a stock rallies into a resistance level, it fails to move any higher and comes back down, goes back up to resistance, comes back down, goes back up. So in this chart, we see the stock has run into resistance 4 times and come into support 2 times before it eventually breaks out above the upper level resistance. Now, support and resistance levels are 2 of the most important indicators we use after price and volume. Support and resistance can be defined in a variety of ways. One is through horizontal price support and price resistance levels. That's what these blue lines indicate here. These are horizontal levels of support and resistance. But there's also such a thing as support and resistance being formed by trend lines and moving averages, which we're going to talk about shortly. At all times, whenever we're looking at a stock in any market, anywhere in the world, we're constantly assessing the chart patterns to identify levels of support and resistance that are significant, that make a difference in determining when to buy a stock and when to sell a stock. The general concept is when a stock breaks out above a resistance level and forms what is known as a breakout, that's the point at which we'll look to buy the stock, assuming the stock is in an uptrend. And once the stock breaks down below support level, that's the point at which we will sometimes sell the stock short, meaning we will look to profit from the stock on a downward move as long as it's not in an uptrend. This is why we're constantly looking for support and resistance levels, because this often constitutes one of the main criteria that we look for in which stocks to buy and which stocks to sell. In this particular example, notice how after the stock broke out, it went higher for about 2 weeks and then came back down. However, when it came back down, notice how perfectly this horizontal line that was prior resistance, okay, before the stock had trouble moving above that level, now it acts as support. This is one of the most basic tenets of technical analysis. That is, a prior level of resistance automatically becomes a new level of support after the resistance is broken. And you can see that here. Resistance was broken, and that prior level of resistance automatically became a new level of support. So this makes it easy for identifying where to set our protective stop loss levels. Because if the stock moves back up above this resistance level and comes back down, it shouldn't move much back below this resistance level. It should hold there, with the exception of perhaps a possible undercut, meaning just the stock moves slightly, 1% or so below this horizontal line, but it shouldn't come, for certainly shouldn't come all the way back down to near this prior level of support. Now the same thing can happen again here. When the stock breaks out above this resistance level you see here around 85, it went back up. Now when it comes back down again, this should act as support. And this is basically what constitutes an uptrend. In addition to higher highs and higher lows, we get kind of a stair-step pattern where each breakout above resistance becomes the new support that the stock can base itself off of and move higher. Now the opposite is true as well, and that is that a prior level of support becomes the new level of resistance once the support is broken. So if the stock was moving lower, and let's say for example if it broke down below the support level and moved lower, then when it bounced and tried to rally, this prior level of support would automatically act as resistance that would prevent the stock from moving higher and present also a potential entry point to sell short or to sell a long position if you're still in. So keep that in mind. Prior level of resistance becomes the new level of support once the resistance is broken. That's very important. Now that you have a basic understanding of support and resistance levels, let's talk about trend lines. Trend lines are also another way of gauging where support and resistance can be found on a stock pattern. In the previous example, we looked at horizontal levels of support and resistance, and trend lines are very similar, except that the trend lines are either ascending or descending. In this particular example, the blue line that you see here is a trend line. This is actually a downtrend line. And a trend line is formed whenever the peaks or the troughs of a series of stock prices line up to converge and form a trend line, and they form what is called anchors. In this particular case, notice we have 1, 2, 3 anchor points. Now we need at least 2 anchor points in order to establish a trend line. But the significance of the trend line is established on the third touch of the trend line. So we see here the first touch of an anchor point after the first 2 anchors are established confirms the significance of a downtrend line. And if it was an uptrend line, it would be the opposite. We would actually connect the peaks, and the same thing would be trending higher. But the first touch of an anchor point after the first 2 anchors are established confirms its significance. Another thing to keep in mind here is that just like we talked about when a stock moves above horizontal resistance, that prior resistance becomes support, it works the same way with trend lines. Take a look here. On 1, 2, 3, 4 occasions, the stock tried to move above this downtrend line and had difficulty doing so. Finally, on a big volume move up, notice the volume here, the higher volume, and a big candle, the stock moves above the downtrend line, and then notice how as it drifts lower, the stock price holds onto new support, okay, new support of this downtrend line, which was prior resistance. Now it's become support. And that enabled the stock to eventually move higher and establish a new uptrend. So when we get a breakout above resistance of a downtrend line, and then a pullback to support of that trend line, that often presents a low-risk buy entry point, which we're going to talk about more when we get to the module on our buy entries and buy setups. Let's take a look at another trend line. Here we have another trend line. Notice the anchor points. This is an uptrend line. Anchor point here and an anchor point here. Now, as we mentioned, confirmation of the significance of this trend line is when the first touch of the trend line occurs after the first 2 anchor points are established. So this is just like the previous example we showed you. Here's another touch of the trend line as well. Here we have what's called an undercut, where the price of the stock moves slightly below the trend line but still stays near it. That happens sometimes as well. Now in this particular case, notice how the uptrend line is drawn on the bottom, connecting the shadows of the candlesticks. We connect the shadows to form the anchor points, but in the previous example we connected the shadows as well, but along the top side. And that can often be done both ways. If we drew a trend line right here, we would actually see an upper channel and a lower channel of the uptrend. That's the lower channel acts as support and the upper channel acts as resistance. So we'll talk a lot about trend lines as we get further into the course, and every day in our daily stock analysis webinars we're constantly looking for trend lines. So this is something that you'll get used to seeing a lot of these. Eventually, when you get good at it, you'll be able to spot trend lines without even drawing the trend lines. You'll be able to just look at a chart and instantly see where there's trend lines. Let's talk about one more thing with trend lines, and that is dirty trend lines. That's a funny name, but the technical scientific approach to drawing a trend line requires that the price action does not pass through the line being drawn. In other words, in all the previous examples we showed you, we connected the trend line with the tops of the shadows of the candlesticks, okay, and we connected with the bottom of the shadows. But a dirty trend line looks like this. A dirty trend line is when a trend line passes through the price action, but it doesn't connect with the peaks. Notice here, in this case where we drew this trend line, notice how perfectly the trend line acts as resistance when we connect it through the middle of the shadows. So we're not connecting the top of the shadows, but we still are forming a very clear trend line. It just lines up very nicely when we have this. Again, a dirty trend line here is kind of a gray area. It's difficult to say how do you draw a dirty trend line and when do you use one. That's why we say it's more of an art than a science. We tend not to use dirty trend lines, but sometimes in a particular chart pattern, you'll see a very obvious example where it makes more sense to draw the dirty trend line because there's more anchor points. The trend line is more effective than if we just connect the trend line through the tops of the shadows. Next, let's talk about moving averages. Once again, just like horizontal levels of support and resistance, and just like trend lines, moving averages are another way of determining where support and resistance levels can be found on a chart. On this chart, you're looking at three types of moving averages. We're looking at a 20-day exponential moving average, that's the dotted line, a 50-day simple moving average, right here, the teal line, and a 200-day simple moving average, the orange line, and volume bars with a 50-day moving average. Now, what exactly is a moving average? Well, a moving average simply shows what the average price is over the past number of days, depending on whatever the time interval is that you're using. So, for example, a 50-day simple moving average would show you the average price of the stock over the past 50 days. And a 20-day simple moving average would show you, for example, the average price of the stock over the past 20 days. Now, we have exponential and simple moving averages. Now, there's not a great deal of difference between the two, so don't get real hung up on this. But basically, a simple moving average places equal weighting on each day within the 50-day period. But a 50-day exponential moving average would actually place more significance and more weighting on the more recent price action. So what happens is when you plot a simple moving average and you plot an exponential moving average, they will come up to be very similar. If we plot a 50-day simple moving average with a 50-day exponential moving average, they're going to return almost the same price. Generally, though, the exponential moving average will tend to show you a little bit price action that's a little bit closer to the moving average. And it doesn't really matter whether you decide to use simple or exponential moving averages, as long as you're consistent in using the same types of moving averages in your trading every day. At Dragon Charts, we use these three moving averages all the time: the 20-day exponential moving average, the 50-day simple moving average, and the 200-day simple moving average. And then with volume, we always want to know what our average volume is, so we look at our average volume over the past 50 days. That way, when we see volume spikes, like you see here, where the volume goes above the average level, it's very quickly to see that the stock is trading on above average volume. Because for breakouts, we like to see volume be at least 2 times the average volume. And notice on each of these big bars up here, notice how the volume did spike, and it moved to about 2 to 3 times greater than the average volume. Every time we see a big bar here, notice the correlation. Big green bar, big volume. Big green bar, big volume. Big green bar, big volume. So, and here again. So by having this volume moving average, we can easily and quickly see when volume is coming in better than average. The whole purpose of moving averages is simply to provide support. Just like we looked at the trend lines and we looked at support and resistance levels, moving averages are an indicator of trend. Okay, they're a lagging indicator, but they're an indicator of trend, and you will find they work very well at predicting where a stock will find support or resistance. If you take a look at this chart you see right here, this is a good example of how a moving average provides support. The dotted line that you see here is the 20-day exponential moving average. And highlighted in the yellow box, notice how the stock first of all broke out above resistance, big volume that you see here. And then as it broke out, it started a new uptrend, and every time the stock pulled back, it touched support of the 20-day moving average and moved higher. Touched support, moved higher. Touched support, moved higher. Touched the 20-day, moved higher. Even up here where it had a big gap up on news, the stock went higher, came back down, but notice how it held support of the 20-day exponential moving average and went higher. So this is a great indicator of short-term support. This can be used for several things. First of all, it can be used for setting stop losses below this moving average, giving the stock enough wiggle room to actually not hit our stop if it probes below the moving average only for a 1 or 2% dip. However, the 20-day exponential moving average can also be used for pullback buying. In other words, when we're buying an uptrending stock, we'd like to wait for the pullback to the 20-day exponential moving average and buy. If you look here, every time the stock pulled back to the 20-day exponential moving average, it moved higher. So every one of these pullbacks was a buying opportunity, a low-risk buying opportunity, versus buying near the peaks. We wait for the pullbacks. Here's an example of the 50-day moving average. The 50-day moving average works just like the 20-day moving average, except it's an intermediate term indicator of support. So again, the 20-day exponential moving average is a short-term indicator of support or resistance, and the 50-day is an intermediate term indicator. Notice here when the stock's moving higher, normally the 20-day exponential moving average catches it, but in this case where the stock comes back down, if the 20-day doesn't catch it, typically a significant correction in the stock will find support at the 50-day moving average. If the stock is a strong stock and it's in a strong trend, often the first pullback, the very first touch of the 50-day moving average is one of our buy entry points. It's very low risk buy entry on the first touch of the 50-day moving average because typically institutions will step in and buy when a stock that's strong pulls back to touch the 50-day moving average. So these are two indicators we always watch closely. We've also got the 200-day moving average, which works very much the same as the 50-day, except that it's a long-term indicator. We don't base a lot of trades on the 200-day moving average, which is why we're not talking about it. But the 200-day moving average is significant because it indicates the long-term trend of a stock. If a stock is trading above the 200-day moving average, then the stock is generally in a long-term uptrend. If it's below the 200-day moving average, it's in a long-term downtrend, and it's difficult to fight the long terms of the trend. The longer that a trend has been intact, the more likely that the trend will remain intact. Another indicator used in our strategy is called the relative strength line, or RS line for short. The relative strength line plots a stock's performance versus a market average. So a market average would depend on which market you're trading in the world. In the New York Stock Exchange, for example, we would plot against the S&P 500 or the Dow Jones Industrial Average. This is an indicator that most direct access online trading platforms provide you with. Interactive brokers, for example, will allow you to plot the relative strength line. And the relative strength line, like I said, it's merely a relative indicator of how a stock is performing versus a market average. The concept is very simple. What we want to see is the relative strength line break out above prior highs before the price action does. In this case right here where we circled it, notice how it breaks out above resistance. We've got horizontal resistance here. The relative strength line breaks out above that level while the price is still well below its prior high. But then what happens is this often drives the stock higher. And notice how the stock moves up to a new high following behind the relative strength line. Now conversely, if a stock is going to a new high, but the relative strength line is not moving to a new high, that's a bearish indicator, and we have to be careful about a false breakout. But generally, this is more an indicator that we use for confirmation. We don't directly make our stock plays based on this indicator, but it's a good indicator of confirmation. If we see the relative strength line breaking out to a new high ahead of the actual price action, that's a good signal, and then we would use our trend lines and our moving averages to further determine where support and resistance levels are. What you're looking at here is something called stage analysis. It's very helpful for a trader to know where the stock is in relation to the overall stages. Doing so will enable you to develop a strategy for taking advantage of different stages and in return become more profitable. Essentially, every stock goes through these same 4 stages. Stage 1 is basing. This is where the price action is just consolidating. It's not really going up, it's not going down. And then we have the breakout above the base, and we enter into a stage 2. Stage 2 is called advancing. Then we have a stage 3 pattern, which is topping. And then stage 4 is declining. Now there's a couple points here. First of all, we like to be in the market primarily during stage 2 when it's advancing. We don't want to be in the market when it's basing, because when a stock is basing, it's going to be just consolidating in a range, and it's tying up capital, tying up our buying power. But once we get a breakout above resistance, Then the stock enters into a stage 2 advance. That's when we look to get in. We like to buy breakouts above resistance, like you see right here. This would be an entry point for us. So you'll hear us talking a lot about breakouts above resistance. Now, stage 3, we want to generally be out before stage 3 happens, and we have a strategy that we use to determine when to exit the stock. Unfortunately, with stage 3, you don't know stage 3 is happening until it's already happened. So we don't know when a stock is topping until it's already topped. So that's why we use moving averages and trend lines and other means of determining when to get out of a stock rather than waiting for stage 3 to happen. In stage 4, we have two choices in stage 4. We either want to just be out of the stock market, sitting in cash, or we look to take advantage of short selling, which is another strategy that's a little more advanced. The whole concept here is we don't want to be trying to buy a stock when it's in a stage 4 move. We don't want to try to pick the bottom. It's very difficult to do. That's known as catching a falling knife, and generally will result in losses. So we want to pretty much only be in the market, in the stock, when it's in stage 2. We want to be out before stage 3 happens, or as it happens. We want to be out during stage 4, and we want to wait. If we're in stage 1, we want to wait till the stock enters into stage 2. To summarize, let's just talk about how we can identify what stage the market is in. When the market is in stage 1 and basing, we will notice that it oscillates between support and resistance, horizontal resistance level and horizontal support level in a trading range. That's how you identify a stock as being in stage 1. Stage 2 is when the stock breaks above an area of resistance and forms a series of higher highs and higher lows, an uptrend, like we talked about earlier. Stage 3, we often don't know that we're in stage 3 until it already happens, but one thing you can look for is high volatility. When the moves, the average intraday move, the intraday range, in other words, starts to widen, that often indicates you're near a top. And it might be in both directions. It might not be only down. You often have big moves up, big moves down, big moves up, bigger than what you saw on the uptrend. So the biggest moves happen during the topping because you get the bulls and the bears. In other words, the buyers and the sellers playing a game of tug of war. And this causes a lot of volatility when you're approaching a stage 3 top. Stage 4 declining, that's apparent because we form a series of lower highs and lower lows. Once we formed at least 2 lower highs and 2 lower lows, we're in stage 4. And it's much like stage 2 in reverse, except the selling intensifies generally more than the buying pressure. Fear is a greater, more powerful emotion than greed. So as a result, stocks tend to go down faster than they go up. So that's why we want to make sure we always identify when we need to get out.